Welcome to a new video that I'm starting to post once a week. This is called Supplemental Charts. This video is designed to go over the charts that I don't necessarily draw or create myself, but we use as part of the videos to gain some insight as to what's going on in the market. This can cover a wide variety of different topics, including the bond market, commodities market, as well as the stock market. This is being prepared for the week of February 6th through 10th. Most of these charts will be from isabelnet.com, which is a blog online where you can go and look at free charts. Since they're free, I go ahead and use those in some of my videos, and they can be rather helpful. One of the areas that we often get some information at is sectors. We like to look at the sectors because that gives us an idea of what's happening inside of the S&P 500. This shows the cumulative global sector fund flows, where most of the money right now is going into tech and healthcare. Even though tech had a really difficult year in 2022, people still like that and they think that eventually it will come back. Looking further out in this chart, we also see some net outflows from real estate, consumer goods, utilities, materials, and then way at the bottom we see financials that have really been out of favor as interest rates have been going up, which is kind of strange, because usually the financials do better during this period, so we're waiting to see what that sector will do. Looking at a sentiment chart, this goes more hand in hand with the other charts that we use. This is more of a composite, where it takes the American Association of Individual Investors, we look at that once a week, Investors Intelligence, which I look at as I'm able to access that chart, the bullish percent index, which we look at every day, the put call ratio, which lately we've been looking at every day, and the active asset managers, which we look at once a week, and then the VIX, which we tend to look at every day. It takes all of those together, and right now is coming up with a positive reading. We're not getting extreme positive currently, where we're starting to show that in some of our other sentiment indicators. The chart just shows how this has been acting right now in comparison to the S&P 500. After getting really extreme negative back in 2022, we are seeing a real improvement currently. We really only pay attention to this when it gets to be extreme greed or extreme fear, and at that point we tend to use this as a contrary indicator. I did show this chart in the weekly update of the active asset managers, just showing how they're giving a reading of 78.37. The reason I included that is because of this next chart. That's the blue line going up where there's more and more buying. And it says here that active managers are chasing price, not fundamentals, and it's looking frothy again. And a lot of that is kind of coming together at the time I prepared this video on February 6th, where the market had been really going up strong. We're starting to hit some overhead resistance. We're also becoming more overbought, and we're likely due for some kind of pullback that will either see a decline or some sideways action. As we're watching the action in the market, will that change the technical picture back to a more negative slant, or are we just pausing right now before we're getting set to go even higher? This next chart also shows the American Association of Individual Investors. They spent a lot of 2022 being extreme negative. Really, where this chart is the most helpful is when we get a real spike down. That often matches with a washout or a climax in the market, and then we see a reversal happening. Well, just because they were negative in 2022 didn't really see any kind of a washout. We have been seeing some improvement with this chart, and we're looking at a possible breakout. At this point, there's a real debate going back and forth, suggesting that the strength that we've seen since the beginning of 2023 is just a bounce in the larger scheme of a downtrend. If we continue to go higher, there's another camp saying that no, this is the beginning of a new bull market and prices should continue up from here. Looking at the economy, a number of yield curves that are inverted right now. The 2 to the 10 year is probably what most people pay attention to, and it's really getting inverted. It hasn't been this low since 1981. Looking back through this chart, we see this is where it was during the financial crisis. Here is how it looked during the dot-com bust. And then going back even further, looking at this chart, even though the person who discovered this and made this really popular is saying that maybe this time is different, a lot of people are still suggesting that we could be going into a recession because this often predicts when a recession may occur. The equity risk premium, what we're looking at here is when we see a real spike up, that's denoting that there's a lot of risk in the market right now, and we're just not seeing that at the current time. The next chart is looking at GDP. This shaded area is the consensus of the top 10 and bottom 10 forecasts, and right in about the middle, they do have GDP declining, where it's a little bit below zero for the first quarter of 2023. We're still waiting to get the final results from the fourth quarter of 2022. This is the GDP Now forecast, where they're still looking pretty positive for the fourth quarter and also suggesting that we will have positive GDP in the first quarter of 2023. Even though it is really coming down, they're suggesting a real economic slowdown. When we get 2 quarters in a row of negative GDP, that's the broad definition of a recession. And there's a lot of debate going on back and forth right now. Are we going to go into a recession? Have we already been in a recession? And will we go into a recession in the future? And are we currently in a recession right now? These are some growth projections looking at the global economy, where they still see it positive overall going out from 2022 into 2023 and 2024. These are more advanced economies where they're seeing less overall growth forecasts. And then the emerging markets and developing economies, this is seeing a lot more favor right now. A lot of investors are seeing more growth as a potential in these particular markets, and these are outside of the U.S. Goldman Sachs has their GDP forecast. They're predicting for the fourth quarter of 2022, we will be at 2.9%. We will still be positive at 0.3% in the first quarter of 2023, and they don't see us going into a recession. These dark diamonds here do suggest that in the second quarter and the third quarter, we will go into a recession, and these are based on other forecasts. We also keep an eye on the leading indicators, or the LEI. That's the dark blue line, which has really been declining. And we have the ISM manufacturing report on new orders. They have been declining, suggesting an economic slowdown. And then the green line is the ISM manufacturing PMI, which just came out last week. This is a little outdated, but it's showing an overall decline in economic activity. This measures the economic output by creating a composite index against the LEI with a 6-month rate of change. Both of these are suggesting more economic slowdown going forward. Another look at the ISM manufacturing against GDP growth. GDP has been bouncing back up. That's the green line, where the ISM manufacturing has been declining. But in the past week, we saw a pretty strong ISM manufacturing report. Pending home sales, the heavy blue line gives the trends for 2022 and then into 2023, where we've been seeing an overall decline in the pending home sales. Real estate really started to show some weakness last fall, but it has been starting to pick up with recent reports that we're seeing. Here's the ISM manufacturing index against the S&P 500. Where the S&P is the purple line, it's been going back up as the ISM has been coming back down. But again, this is a little outdated. This chart suggests that there's a clear signal for industrial production declines and a U.S. recession in 2023, where the red line and the blue line continue to decline. Global equity valuation indicators show that after really climbing up and then decreasing, we're seeing a little bit of improvement with the small cap when you compare it to large cap. The value growth continues to show that value is outperforming growth. And then if you take non-U.S. stocks against the U.S., that's the black line here, we're seeing a little bit of improvement, and that's why you're hearing a bit more buzz about getting into other markets outside of the U.S. This is the housing price index. That's the purple line, where housing prices have been going up, but they're starting to level off. Down here are the average hourly earnings, and it's showing that people are not really able to afford these houses at these current prices. So will the price come down, or will earnings go up? Some inflation measures that we look at, it just shows that inflation is a monetary phenomenon. When we hit the whole COVID lockdown, there was this massive influx of money into the U.S. economy to try to stimulate things. As the money's been coming out, that's the black line, we're seeing CPI start to come down as well, and that's an inflation measure. We're waiting to see if this will continue with a decline in inflation, but there's been a lot of fears lately that inflation could pick back up if the economy stays fairly strong. This just shows the net job gains going back all of 2022 and now into 2023. We had a really strong jobs report in January, which is not reflected. We had a really strong employment situation report on February 3rd, which is not reflected in this chart, but this is suggesting that there will be a decrease in the net job gains, and they're projecting out pretty much flat for the rest of 2023. This looks at job cuts and compares it to initial jobless claims. We're seeing a real decrease in jobless claims right now. Well, the Challenger U.S. job cuts are really starting to spike up. We might start seeing that reflected in the initial jobless claims. This chart suggests that corporate profits are the key driver of the labor market, and if you think about it, that makes sense. If a company's making more money, they can afford raises, they can afford to hire more people. If their profits are going down, they may have to have price cuts or not hire as many people, or in fact let some people go. This dark blue line is the month-over-month U.S. payrolls with the 3-month average, and it shows how it's been coming down. The ISM manufacturing and new orders, another chart that we looked at a bit ago, it also shows a real decrease, and this could bite into the employment situation. This chart looks at all employees as well as temporary help services. When this is really going up, that's more healthy. When it goes up and starts to come back down, that means that there's a contraction in the employment picture. Right now, we're coming back down below this black line, and it's starting to go negative, and that could suggest some employment weakness going forward. Looking at earnings and valuation, the earnings weakness of the magnitude we're projecting is historically a risk to the labor market. As the forward-looking earnings per share has been coming down, that bites into corporate profits. That could influence this yellow line to really start going up. This is the unemployment rate. This is a Morgan Stanley chart where it says our earnings model points to a steep deceleration, continuing to go down based on the earnings of the S&P 500. This chart says typically when forward earnings per share growth goes negative, the Fed is cutting rates and not hiking rates. That's part of the debate that's going back and forth. We're seeing earnings per share being lowered, and yet the Fed is still raising rates at the same time. Can that produce a soft landing or the type of situation where we prevent going into a recession? The blue line shows the decrease in the earnings per share and then the forecast going forward. The yellow line is the Fed funds rate as they continue to raise interest rates. This is another Goldman Sachs chart. It says, in our soft landing baseline scenario, we expect zero earnings growth and a flat S&P 500 index in 2023. The current level when this chart was created is right here. They see earnings picking up a little bit and then being flat throughout 2023 and then resuming an uptrend into 2024. The current level of the market is lower than that. This is suggesting with the earnings per share decline that we will end up being at about 4,000 in the S&P at the end of 2023. The next chart says, but the S&P 500 earnings revision sentiment is negative and at levels only surpassed in 2008 and 2020, both very difficult times, which points to a hard landing. So here's part of the debate going back and forth. The Fed is trying to have a soft landing, but some of the charts suggest that there could be a hard landing, meaning that we go into a recession. The Fed Watch, I have other Fed Watch probabilities of what the rate hikes will be. This goes back to November 2022 and just showing what the Fed actually did. And this is what they predicted. This was before the Fed made their announcement and what is likely to happen going forward. They asked a number of folks to state how they feel. 52% of those asked said that the Fed will lower interest rates in the first half of 2024. That's suggesting that they won't be able to lower interest rates in 2023. This tries to chart out the expectations for the Fed policy rate, where we're coming up right now. This is about where we're at. They feel that we'll top out just under 5%, go sideways for a while, and then start to decline from that point. Looking at the S&P 500 and some different stocks, here's the technical overbought and oversold composite. We're getting a little toppy now. We really start to pay attention to this when it gets above 75. It's right now at 74.95. And that kind of goes hand in hand with some of the other charts that we're looking at, and that we're at a short-term and intermediate-term overbought condition. This chart is a little difficult to figure out. It's the aggregate U.S. liquidity measure, and that suggests that there's downside for the S&P. They're generating a sell signal over here, which is the yellow line, as the S&P has been coming back up. The S&P 500 is the dark blue line here that's been bouncing up lately, and this is the Goldman Sachs Financial Conditions Index. These do have a tendency to go in opposite directions of each other, and they're kind of crossing close to each other at the current time. What we are seeing are a lot of buyback authorizations that companies are buying back their own stock, and that's really increasing so far in 2023. This also suggests that there's a lot of buybacks going on, not as high as other levels were, but as the market is going up, companies are deciding to buy back their own stock, and this often produces positive price action. The weekly equity fund flows show that for the last 2 weeks, we've seen net inflows into equities or stocks. The insider transaction, after getting a real high reading, this has now been coming down. These are folks that are the president, the CEO, or officers of a corporation. When they buy or sell stock, they have to report that because they tend to know things that are going on inside of the company, and it would be more fair if they told everybody what they're doing. The problem is there's a real delay from the time they do this transaction until it's actually reported. This number, after going up really high, has been coming back down, and this could be bearish for stocks. When it drops down below this black line, that's where it turns more bullish. Emerging markets have kind of been a buzz lately. It just shows that a lot of money has been flowing into emerging market assets. This kind of complicated looking chart just shows how margin debt has really been decreasing. Some long-term charts, this is the BPI, the bullish percent index, which we look at every day. This chart is a little outdated, where we're actually getting up above this 80 level currently. At the time this chart was produced, it was at 67.4. This shows the internal strength of the S&P by looking at all the point and figure buy or sell signals, and we've been really advancing overall. Some broad market looks. This is looking at gold. It says gold speculation positions are starting to go up as gold has been going up lately. This suggests that China reopening could boost oil prices by up over 20%. The baseline is the dark blue area where they do suggest that it will go higher. If we have a faster reopening, then oil should rise faster. If there's no reopening or they lock things down again, we might see things actually start to decline after initially going up. The dollar really did well in 2022, but it's now starting to see a lot of weakness. And this just says US dollar has rarely, if ever, had this precipitous of a decline. Rebounds often follow. We saw a really nice bounce in Friday's session. We'll want to see, is that going to continue over into changing the trend, or is this just a bounce before the dollar gets set to go even lower? Looking at bonds and interest rates, there's a lot of credit conviction right now. A lot of people are getting into investment grade and high yield bonds where they were completely out of favor in 2022. This chart says here's a sign of greed. It's the spread between the triple B rated corporate bond yield and the 90-day U.S. Treasury yield. When this gets pretty low, this suggests that maybe they're overdoing it a little bit in the bond market. And if we see this start to go back up, we might see some pressure put on bonds as well as stocks. This is projecting out U.S. debt, and it's expected to skyrocket in the next 10 years. And this chart suggests that if debt of the U.S. government continues to go up over the next 10 years, we'll be back to about where we were at World War II levels. Thank you. I hope you found this useful. I tried to organize these charts a little bit to put them in the same general category. Let me know if you think of this. These charts, they go outside the realm of me actually creating them, so I don't always understand the logic and the rationale behind each chart. That's why I pulled them out of the videos that I do, because I work with charts in those videos that I created, and I know how the logic works in those charts. Let me know what you think of this, and I will talk to you in the next video.